A beat on revenue, a beat on earnings, margin expansion, up to 200 basis points, huge growth in their subscription offering segment. This services segment is highly profitable, and it is the future growth engine for this cybersecurity firm. They also raised their guidance for revenue and operating margins. A stellar quarter, right? A pop in the market, perhaps. Nope. This stock fell 10% on the news. Owning Fortinet, ticker FTNT, can be a roller coaster. Welcome to the Quality Investor. Fortinet's earnings showed an all-around solid quarter in an otherwise weak market, especially in their own industry as firms are cutting back on hardware as seen in their product segment. But what the market really didn't like was their billings number. Fortinet uses billings as a proxy for future revenue potential, and it shows up in deferred revenue. And this was down 6.4% year over year. And with that poor short-term expectation, the market punished Fortinet with a 10% drop in their share price. But before we get into it, remember to like this video below and subscribe to the channel so you can stay on top of all the quality businesses in the market. I want to dig in to Fortinet's earnings today and see how much this lowered billing expectation affects Fortinet as an investment. The explanation offered is that the year earlier quarter was exceptionally higher than normal. Fortinet is seeing weakness in demand as well as slowed firewall growth due to businesses moving away from on-prem data centers. This is a concern for Fortinet as 32% of their revenue is in their product segment. However, Fortinet is shifting their business model to cater to more apps and cloud services, their services segment, and they're seeing success. This is their growth engine going forward. I see this as a long-term growth runway for Fortinet because the margins are exceptional and they're building a strong network effect for customers. Using a suite of Fortinet services makes their cybersecurity needs more seamless and cost-effective. It also makes it less likely for a customer to switch to a competitor. As we'll see, growth here over time will improve margins, which will ultimately lead to more free cash flow, either for reinvestment or for shareholders. So let's take a look at this quarter. Starting out with a summary of their results for revenue, we can see that billings number here, 1.407 billion. This is a 6.4% drop year over year and their lowest number since Q2 of 2022. They did see revenue growth of 7.2%, but that is weaker compared to all their other quarters here in the past. And of course, the most concerning number I think is that products revenue segment, dropping 18.3% for the quarter. All of this is signaling very weak demand in an environment where things are slowing down generally across the economy. But they did have a bright spot, and that is in their services segment, 24% growth in services. And most importantly, this services segment now makes up 70% of their revenue. This is going to be very important, as we'll see, especially for the future of Fortinet. However, moving on from those disappointing revenue numbers, we can see some real positives for Fortinet. Their gross margin of 78.1% is a huge growth year over year from 76.3%. Their operating margin of 28.5%, also huge growth from 26.5% a year ago. Margin expansion is one of the best tools for value creation. What this is signaling to me, especially for their gross margin, what the gross margin expansion is signaling is strength in operating leverage for their services segment, and they're becoming more efficient in their overhead when it comes to the operating margin. You can also see their diluted earnings per share up to 43 cents over 34 cents from a year ago. To me, this is signaling growth in the right areas for Fortinet as well as profitability going forward. So why do I think that Fortinet is doing the right things by focusing on their services segment? Well, let's take a look at this gross margin here. So services in the Q1 of 2024, they had gross profit of 822.5 million. That is a gross margin of 87.1%. A year ago, they had gross profit of 647.4 million in their services segment. That's a gross margin of 85%. So over a 200 basis point increase in gross margin. Additionally, the services segment is growing in terms of a percentage of revenue. The services segment made up 70% of revenue in this quarter as opposed to 60% a year ago. So as services drive growth for Fortinet, they're only going to become more profitable as that services segment becomes more of the revenue for Fortinet. That's ultimately going to not only grow the gross margin, but operating margins as well. So what does that growth actually mean? What is actually growing for Fortinet? Well, here in Investors Business Daily, the article Firewall Market Blues, Fortinet earnings top views while billings miss. They mention that down here. Fortinet and many other cybersecurity firms are focused on a new growth market, Secure Access Service Edge, SASE. It offers a fast and cost-effective way of securing an organization's branch, offices, and remote workers. This is important because in the previous paragraph, it states that growth has slowed in the firewall market as companies buy less computer network gear for on-premises data centers. Companies are shifting business apps and workloads to distributed cloud platforms. And you can see here, according to Fortinet, their unified SASE is now 24% of their Q1 2024 billings. So more of their future revenue is going to be coming from the unified SASE market. You can also see this strong push by Fortinet management to make unified SASE a huge part of their future growth. Look at in Q3 2023, 20% compared to today, Q1 2024 of 24%. It is the focus of management. They're pushing that growth for unified SASE. And it's obvious why. Universal SASE is projected to have a 18% compound annual growth rate by 2028. This is for the total addressable market in cybersecurity. But look at the hardware side of things, secure networking, only an 8% compound annual growth rate. So Fortinet is doing the right thing by focusing on universal SASE. It will allow Fortinet to increase their subscriptions and their margins. On the earnings call, analysts seemed most concerned with the recovery of the firewall market, as well as when Fortinet would see a pickup in their billings, which makes sense as those are the two worst performing segments of the quarter. But despite that, we can see some pretty impressive operating cash flow growth here. The CEO even mentioned this on the earnings call as they saw a massive acceleration in their days of sales outstanding, which you can see in this account receivable increase here. 405 million decrease in account receivable leads to a 405 million increase in cash. The CEO also mentioned how that led to higher operating margins. Ultimately, that gave them a cash flow from operations of $830.4 million for the quarter, far higher than the previous 8 quarters. And because of that, they made a large capital expenditure of $221.9 million in the quarter. While free cash flow is slightly down year over year to $608.5 million, it's still a very impressive over $2 of free cash flow conversion. The company expects to make about 50 million more in capital expenditures per quarter for the rest of the year. So we should see even more free cash flow going forward. They've made a bulk of their capital expenditure up front in the first quarter. One more slide here before we move on to the valuation is the days to register security service contracts. This is a metric that Fortinet uses as an overall health measure of the firewall market. And you can see here that it has been declining steadily since 2022. And management stated on the earnings call that they expect this to normalize by the end of 2024, back to these levels in this area here. So what does this quarter mean for Fortinet's valuation? Are they still a stock that we should keep buying? Let's start out with the revenue model for Fortinet. You can see our product and service segments here. In 2023, products did $1.9 billion in revenue and services did $3.4 billion in revenue. But what's important here is that mix of revenue. Services made up 63.7% at the end of 2023. The gross margin for services was at 86%. That gave a gross margin of 76.7% for all of Fortinet. The product gross percentages was about 60%. So with management focusing more on expanding their services segment, growing that part of the business much faster, and you can see that's what we're assuming here, at a 12.5% compound annual growth rate over the next 10 years for service versus 6.3 compound annual growth rate for the products. That's going to make the service as a percent of revenue 75% at the end of year 10. And assuming that that service gross margin expands to about 89%, that'll give a gross margin for all of Fortinet at just over 80%. This is assuming the product gross margin is actually at 55%. So we're actually assuming the product gross margin falls about 5% over the next 10 years. The reason the services gross margin can expand, there's a very low variable cost for services. A lot of services is setting up initial infrastructure as well as having subscription type revenue. That means it costs very little to acquire a new customer that has a high operating leverage. So while your variable costs and the services generally stay pretty low, each additional unit of revenue increases gross margin. So ultimately, we're expecting about 10.5% compound annual growth for revenue as a whole for Fortinet. Looking at the growth of the rest of the business altogether here, we're expecting the operating margin to expand to about 28%. This assumes the current operating expense margin as a percentage of gross profit improves to about 65% by year 10. And factoring in with that gross margin that we had at year 10, that gives us an operating income margin of about 28% at year 10. We're using 25% for year 1. Our net income margin at year 10 is going to be about 22.7%, and our free cash flow margin at nearly 32%. So we're assuming that free cash flow itself will grow about 10% over the next 10 years, and discounting that back will give us a discounted cash flow price at $82.84. Now, I did lower my expectation for operating percent margin from my original forecast. I had it at about 30% at year 10. I was factoring in the new information regarding this quarter, as well as getting a more granular look at how the services gross margin and the operating expense margin as a percent of gross margin all played together. So we are expecting over the next 10 years, about half the free cash flow growth that they experienced over the last 3 to 5 years. For my exit multiple comparison, I'm using Palo Alto Networks, CrowdStrike Holdings, VMware, Cloudflare, Zscaler, F5, ServiceNow, and Checkpoint Software Technology. Using a median PE of 44.7, we have an exit multiple price of $68.39. So we saw a pretty hefty drop in the market on Friday after Fortinet had their earnings released, down to $58.88 a share, nearly a 10% drop. That brought their PE ratio down to 38.5, which is well below their 5 and 10 year average. Their forward PE is at 39.2, also quite below their 5 and 10 year averages. I do feel like the market overreacted a little bit to Fortinet's earnings. I do think the lack of growth for products is a little bit concerning, but I think they'll be able to more than enough make up for that with their services growth, and we should see strong cash flow generation out of Fortinet for years to come. The other thing about Fortinet is they have a very impressive return on capital, 143.9% on a trailing 12 basis. Over the last 10 years, they've averaged 42.7% ROIC. This business is able to generate a lot of operating income based on very little invested capital. It's exactly what creates value for investors in the long term. And we know that their margins are only going to increase over time. So right now at a 20% margin of safety, I have a buy price of $63.24. This is assuming a 25% probability for my bear case, a 50% probability for my base case, and a 25% probability for a bull case. And you can see those valuation averages right here. So we'll see what they do in the market over the next few days. It's possible they might even come down a little bit more, maybe even under $55, which would be within a 30% margin of safety. Either way, I do think this drop in the market on Friday really presented a nice buy opportunity for Fortinet. I really encourage you to check out the investor materials they had along with their earnings. I have them linked in the description, but this business is an incredibly strong balance sheet, and it is in a very important industry for the economy over the next couple decades. There's going to be a lot of growth ahead for Fortinet, and they are already one of the top players in the industry, and I certainly expect them to continue growing, especially on the services and subscriptions that they offer already. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.